Who is to blame for today's high mortgage interest rates?
We're Rod and Melody, your guides to living in Salt Lake City and beyond. With over 30 years in Utah real estate, we're here to help you navigate this beautiful state with confidence. We make videos about living in Salt Lake, exploring the suburbs, and what life in Utah is really like. We've helped over 1,400 families make their move in, out, and around Utah. And whether you're headed to St. George, South Jordan, or Smithfield, we've got you covered.
Hey guys, my name is Rob Moser. I'm a local real estate agent. I've been selling homes for 25 years. And prior to that, I actually did mortgages for several years. There is something that has been driving me absolutely crazy lately, and it is all of the hate on Jerome Powell for not lowering the federal rate and causing the housing market to get kickstarted. Guys, I have bad news for you. If you're in that camp, the Federal Reserve rate does not directly impact mortgage interest rates. Let me do my best to explain as quickly as I can. First of all, when the Federal Reserve lowers the federal rate, who it helps is it helps companies. Companies are able to borrow money at lower interest rates, which allows them to expand. So it can really have a big impact on the labor market. The other thing it does is it lowers your credit card rates because it lowers the prime rate. So those are things that it helps. What it does not do is lower your mortgage interest rates. Where does that number come from? Guys, to understand that, it's basically financing, simple financing. One of the lowest risk investments throughout our fiscal existence in the United States has been Treasury bills. When our government spends more money than they bring in for taxes, they have to get money to pay those debts. They do it by selling Treasury notes. We have short-term Treasury notes and long-term Treasury notes. The long-term Treasury notes is typically the bar that mortgage interest rates use to see where they should float. They're usually about 1.8 to 2% on top of or a higher yield than the long-term Treasury notes. So here's the question. How do we get that lower? Well, we've had a couple of things happen this year that has not helped. The first is our country's credit rating got downgraded, meaning that it's a higher risk for investors to buy our debt. Part of the reason for that is we spend way more money than we bring in taxes. Well, let me share with you really quickly an article. This came out yesterday. This is a record, and this is from MarketWatch. $100 billion auction for short-term Treasury bills is coming Thursday, which is today. The government has, or the Federal Reserve has decided to, the government has decided to sell Treasury notes short term so that it won't have an impact on long-term Treasury notes, which could, as we flood the investor market with additional debt, that causes that yield to go up, which is going to cause mortgage rates to go up as well. So we've been doing it short term and trying to avoid the hit on mortgages. Earlier this week, the nonpartisan Congressional Budget Office estimated that the fiscal signed into law by Trump on July 4th, officially known as public law, whatever, it's the One Big Beautiful Bill Act, will result in an estimated impact on the federal deficit of $4.1 trillion over the next 9 years, after factoring in debt servicing costs. Trump's budget law could widen the deficit by an additional $718 billion, so we are closing on $5 trillion of increased debt over the next 9 years. That is not good for mortgage rates, guys. So when we look at who really is to blame for those high interest rate mortgages are considered a fairly low risk investment, but slightly higher than taking on the United States government debt. So they always float 1.8 to 2% above that. That causes people to buy those and get a return on their money. What artificially held rates lower for a long time is that the Federal Reserve was buying mortgage-backed securities to kind of boost the economy. They did that for a long time. When did they stop? Well, they stopped in 2022. And if you guys remember, in the early part of 2022, we had interest rates at about 3%. What happened? Over the next 6 months, when the Federal Reserve stopped buying mortgage-backed securities, those interest rates climbed all the way to 8%. So when we had to go back to the natural state of things and we weren't subsidizing the debt so that we could infuse the mortgage markets with more cash because investors weren't willing to buy them at those low rates. So in order to give us those low rates for as long as they did, the Federal Reserve was buying mortgage-backed securities. They stopped that in 2022, and instantly the rates floated to right where they're supposed to be, which is where we're at today. Here's the bad news, and I'm just going to end this on this bad news. There are three potential outcomes to make things better. The first is if we can get interest rates on mortgages lower, then it would kickstart the housing market and things could get better. Based on everything that we're seeing, unless the Federal Reserve starts buying mortgage-backed securities again, which I don't think they will, rates are probably going to be here. They might even go a little bit higher than where they're at today. So that's probably not an option. Here's the second one. Businesses start paying their employees a higher wage. And the reason that I'm saying this is because we don't have a demand problem. Everybody wants a home. We have an affordability problem. They can't afford to buy one at today's prices and today's rates. So if rates don't come down, the next option is for income to go up. Well, guys, it didn't happen during the first trickle-down economy that Reagan put together in the 1980s. It didn't happen in Trump's first term, and it certainly isn't happening today. The wealthy are getting wealthier, and they're not increasing the wages in order for people to be able to afford the houses. So what is the third possible outcome and most likely outcome? House prices have to come down to a point where they're affordable for people to be able to buy them again. Most of the people that were buying homes over the last several years were investors that were buying, 25% at one point of the houses that were sold across the country were actually purchased by investors, not primary residents. So that's why we had a shortage of inventory and a really high demand, because a lot of those investors were buying those properties. Well, the investors have lost their appetite because they can't cash flow the properties at today's rates and today's house prices, and so they've stopped buying. We are starting to see inventory levels climb. We're seeing demand drop because of affordability. So the most likely outcome, in my opinion, guys, is that we will start to see house prices come down to a point of affordability. All right, I hope this was educational. I hope it helps. I felt it necessary because this has been driving me nuts. It's not Jerome Powell's fault that mortgage rates are where they're at today. It's the fact that every administration has continued to spend beyond their means. They've continued to borrow money, sell Treasury bonds to cover the debt that we can't bring in taxes. And because of that, it's caused those yields to go higher, which has caused those rates to go higher. Feel free to comment below. I'd love to hear your feedback. Hopefully this has been helpful. Thanks, guys.